Every single country on our planet is buried in debt. The United States alone owes a staggering $38 trillion. Japan is on the hook for about $9 trillion. And when you add it all up worldwide, the total hits $315 trillion. That's 3 times bigger than the entire global economy. But here's the mind-blowing twist that should really make you think. If everyone's borrowing money, who exactly is getting paid back? The answer might surprise you. When you dig into who actually owns all this debt, you find something unsettling. The world doesn't owe money to any one person or group. It owes money to itself. And this setup wasn't an accident. 4 clever bankers, spread across 300 years, deliberately created a system where debt can never truly be paid off. Governments keep borrowing endlessly, interest keeps flowing upward forever, and those who built the trap profit from every payment, every crisis, and every bailout. This isn't some wild conspiracy theory. It's real history, backed by meetings, contracts, and public records. Once you see how they put it together, you'll realize that $38 trillion isn't a problem to fix. It's the system running exactly as planned. Let me walk you through the 4 masterminds and the key moments when this debt trap was locked in place. Every government on Earth is now stuck in it, with no easy way out. Let's go back before 1694. Kings used to borrow money the old-fashioned way. They'd ask merchants or wealthy nobles for loans, promising to pay back with some extra interest. If they couldn't repay, they'd just default, and the lenders would lose their money. It was risky for everyone involved, and kings often felt embarrassed, but the debt was temporary. It got paid off or wiped clean, and the system reset. Then came William Paterson, a Scottish businessman and schemer who had tried, and failed, many times to strike it rich. In 1691, with England fighting France, King William III was desperate for cash. The royal treasury was empty, taxes weren't enough for the war, and no one wanted to lend because England had defaulted before. Paterson had a game-changing idea. He gathered a group of rich merchants to lend the government £1.2 million. That's roughly 300 million in today's dollars, a huge amount back then. But here's the clever part. The loan would never be fully repaid. Instead, the government would pay interest forever, at 8% each year. To handle this, Paterson suggested creating a brand new institution, the Bank of England. The setup was revolutionary. The merchants handed over their gold to the bank, which then lent it to the government. The government paid the interest from taxes, and the bank passed that interest back to the merchants. Crucially, the government never had to return the original amount. Why did the merchants agree? Because Parliament guaranteed the payments, backed by the power to tax citizens. As long as England could collect taxes, the interest kept coming. Plus, the banknotes they got in exchange for their gold could be traded like money. And even better, they earned interest. Parliament approved it in 1694. The Bank of England was born. The merchants provided the gold, and the government got its war funds. For the first time ever, a country's debt became permanent. Not something to solve, but a built-in feature of the system. Now let's break down why this was genius for the bankers. The government paid 8% interest on £1.2 million, which meant £96,000 every year, forever. It was like the merchants had bought a lifelong income stream from the government. As long as England existed and could tax people, the money flowed. If they wanted their gold back, they could sell the banknotes to someone else. The debt could be passed around but never fully cleared. But Paterson's real stroke of brilliance was next. The Bank of England got the power to print banknotes backed by the government's debt. They could create paper money up to the value of the loan. Suddenly, debt itself became currency. The more the government borrowed, the more money could be printed. This became the blueprint. Governments borrow, never repay the main amount, pay interest endlessly, and the debt turns into money. It's a win for bankers, but a burden for taxpayers, who keep paying interest on debt that never goes away. Within 50 years, major European countries copied this model. France set up its own system, the Netherlands refined theirs, and by 1790, the new United States adopted it too. Alexander Hamilton, a key figure in American history, modeled the U.S. financial system directly on the Bank of England: permanent debt, interest from taxes, and bonds that act like currency. Paterson passed away in 1719, not super wealthy himself, but his creation lives on 331 years later. The Bank of England is still around, and Britain's government debt has never been fully paid off. It's just been refinanced, rolled over, and grown bigger. The debt trap was set in 1694, and every government since has stepped right into it. Fast forward to the early 1800s. European governments were deep into borrowing for wars, buildings, and daily operations, but there wasn't an organized market. Each loan was a one-off deal, with varying interest rates, and only the richest could join in. Then Nathan Rothschild changed the game. He industrialized government debt. The Rothschild family started as money traders in Frankfurt, and by 1800, the five brothers had banking operations in London, Paris, Frankfurt, Vienna, and Naples, a network like no other, letting them move money across borders faster than anyone. Nathan, based in London, was the mastermind. During the Napoleonic Wars, he arranged loans for Britain, but his big innovation was how he handled them. Instead of lending directly, he bought government bonds at a discount and resold them to investors at a higher price, creating a secondary market. Governments got cash quickly, Rothschild pocketed the difference, and investors got a tradable asset. But it gets darker. Rothschild didn't just fund governments. He positioned himself so they had no choice but to rely on him. In 1815, at the Battle of Waterloo, Nathan got news of Napoleon's defeat before anyone else in London thanks to his speedy couriers. He used this edge to manipulate the bond market. First, he sold British bonds, making it look like Britain was losing, which crashed prices. Panicked investors sold too. Then Nathan scooped up huge amounts at bargain prices. When victory news hit the next day, prices skyrocketed and he made millions. Not from illegal insider trading as we know it today, but from controlling info and timing the market perfectly. This set the Rothschild standard. Control the information, the loans, and the market. By 1820, they dominated European debt. If a government needed money, it went through the Rothschilds. They had the connections and set the rules. Why does this matter for the debt trap? Before Rothschild, governments could sometimes just refuse to pay. A default might hurt creditors, but the system would reset. Rothschild made debt tradable worldwide. A British bond could end up owned by a French investor, then sold to a German bank, which might use it as security for a loan to an Austrian noble. The ownership web got so tangled that defaulting wasn't just ditching one lender. It could crash the whole international financial network. This was Rothschild's genius. Make debt so interconnected that default becomes unthinkable. Not because governments are honest, but because it would cause global collapse. Nations got trapped. They had to keep paying and borrowing more just to cover the interest on old debts. The trap wasn't just permanent anymore. It was inescapable. The Rothschilds became the richest family in the world by the mid-1800s, wealthier than any king, all from collecting interest on government loans. They didn't make or build anything. They just lent and profited forever. Paterson's 1694 system got supercharged by Rothschild in 1815, and every European government was hooked. By 1900, America was booming economically, but its banking was basic. Banks worked alone, money was tied to gold, and there was no central way to manage debt. J.P. Morgan fixed that, not for the public's sake, but to protect his own banking empire. In 1907, a big financial panic hit. Stocks crashed, banks failed, and the economy froze. Morgan personally stepped in, gathering New York bankers in his library, locking the doors, and forcing them to pledge their own cash to save failing banks. It worked, the panic stopped, and Morgan became America's unofficial central banker. But at 70, he knew he couldn't do it again. So he and his powerful banker friends designed a lasting fix, a central bank. Americans hated the idea. Past attempts had been shut down by public outrage. Morgan's crew hid it well. In 1910, they held a secret meeting on Jekyll Island, Georgia, for 9 days, plotting what became the Federal Reserve System. They kept it quiet because they feared riots if people knew bankers were designing the nation's money rules. The plan was a masterclass in clever politics. The Federal Reserve wasn't called a central bank. It was a system of 12 regional banks. It wasn't one big institution, and it wasn't run by Wall Street directly. Instead, a board of governors appointed by the president would oversee it, making it seem decentralized and democratic. But behind the scenes, bankers controlled it. The regional banks were owned by member banks, which elected their boards, and those boards picked the Federal Reserve Board. The government appointed some members, but the real power, the ability to create money and buy government bonds, went to the New York Federal Reserve Bank, run by big Wall Street firms like Morgan's. The Federal Reserve Act passed Congress in December 1913, mostly because lawmakers didn't fully grasp it, and right away, the debt trap grew bigger. Now the government didn't just borrow from banks. It borrowed from the Fed, which could print money to buy bonds. There was endless demand for government debt. Here's why this was huge. Before the Fed, governments could only borrow as much as banks had available. But the Fed could create money by buying bonds. The government issues a bond. The Fed buys it with new money, the government spends it, and the debt sits on the Fed's books, backed only by taxpayers' future payments. This allows infinite debt. The Fed always buys bonds, so governments never stop borrowing. They just roll over the debt forever, and interest goes from taxpayers to the banks owning the system. Morgan died in 1913, the year the Fed was created, but his setup makes today's $38 trillion in U.S. debt possible. Without the Fed as a buyer, the market couldn't handle it. With it, there's no limit. The trap became limitless. By the 1970s, the debt system, built by Paterson, Rothschild, and Morgan, was running worldwide. Rich nations borrowed, refinanced, and paid interest. But poorer countries borrowed for roads and factories, and many struggled to keep up. The trap was hitting its limits, until Paul Volcker made it permanent. As Federal Reserve Chairman from 1979 to 1987, Volcker faced high inflation over 10%, and foreign trust in the dollar was fading. He raised interest rates sharply, from 11% to 20%, the highest ever, to crush inflation, even if it caused a recession. This backfired on developing nations. They'd borrowed billions in dollars when rates were low in the 1970s. Now, with rates tripled, they couldn't afford the payments. Mexico owed $80 billion, Brazil $60 billion, Argentina $40 billion. The interest alone ate up their export earnings. In 1982, Mexico defaulted. This could have sparked a global crash, since U.S. banks had lent most of the money. If Mexico failed, big banks like Citibank and Chase would suffer huge losses, possibly failing themselves. Volcker could have let the market sort it out, but he didn't. Instead, he arranged bailouts through the International Monetary Fund (IMF). The IMF lent Mexico, Brazil, Argentina, and others just enough to keep paying interest to U.S. banks. These were called structural adjustment loans, with strict conditions. Cut spending, sell off state-owned companies, open markets to foreign investors, weaken currencies. Basically, give up economic control to keep the debt payments going. And here's the catch. The loans didn't erase debt. They just restructured it, making it last forever. This was Volcker's big move. When debt gets too heavy, don't wipe it out. Restructure it, lend more to keep interest flowing, and demand political changes in return. The debt trap became a tool for control. Countries that couldn't pay had to open up, sell assets, and follow foreign rules just to stay in debt. This pattern has repeated for 40 years. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Same story. IMF loans for interest payments, harsh cuts, lost sovereignty, and debt that never truly ends, just gets reshaped. Volcker passed away in 2019, but his method ensures the global debt trap is unbreakable. Even when nations can't pay, they don't default. They get refinanced into endless borrowing, and interest keeps going to the same banks and institutions. It's the same system Paterson started in 1694. Now, let's tie it all together. Paterson's idea: governments borrow and pay interest forever, no full repayment. Add Rothschild's twist: make debt tradable globally, so defaulting risks worldwide collapse. Layer in Morgan's Fed: central banks print money to buy bonds, creating unlimited borrowing. Top it with Volcker's bailouts. Restructure unpayable debt to keep interest coming, extracting control. The result? Today's $315 trillion in global debt. Government, business, and personal. All interconnected, none ever fully repaid, all generating interest. Default anywhere could crash everything. Take the US, $38 trillion in debt. About $20 trillion is owned by Americans. Pension funds, mutual funds, insurers, banks, and the Fed. These buy treasury bonds as safe investments, earning about $1 trillion in interest yearly, paid by taxpayers. It's a yearly transfer from workers to the wealthy. The rest, $18 trillion, is owed to government programs like Social Security, which lent money that was spent. Taxpayers still foot the bill. Globally, it's the same. Japan owes mostly to its own banks and central bank, Europe to its banks and ECB, China to state banks, and it's all linked. Japan holds US bonds, the US holds European debt via the IMF, and so on. Everyone owes everyone, and interest rises to the top. Why can't this end? If the US paid off its $38 trillion, the money supply would shrink drastically, causing deflation and depression. Dollars are created through borrowing. If debt vanishes, so does much of the money. Same worldwide. Paying off all debt would cut the global money supply by 2/3, halting trade. Debt is built into the system. It's necessary by design. Who wins? Big asset managers like BlackRock, Vanguard, State Street, and Fidelity, controlling trillions. They buy bonds with pension money, insurance funds, and retirement savings, collecting interest. Over $1 trillion a year from US debt alone, plus more globally. It's the biggest hidden wealth transfer ever. Workers pay through taxes, institutions profit, and debt never shrinks. The four architects didn't plot together. They lived centuries apart. But each fixed a banker-friendly problem, building on the last. Paterson made debt permanent in 1694. Rothschild globalized it in 1815. Morgan infinitized it in 1913. Volcker made it inescapable in 1982. Together, they created a world where governments borrow eternally, paying interest forever to financial institutions. For them, 38 trillion isn't a crisis. It's a profit machine. Every debt dollar is an asset earning interest, enabling more borrowing. As long as people trust the system, it keeps going. If this video has shifted how you view government debt, if you now see that 38 trillion isn't a mistake but a deliberate design, then you're starting to understand real power. Subscribe for more on how this machine was built and who's running it. Schools won't teach you this. They'll say debt is a problem to solve. But the architects knew. Debt is the foundation, and interest is the rent we all pay to live in their world.